Hi there. This is the third installment of our discussion of the cost of capital. Today I shall turn my attention to the cost of debt and then go on to conclude the discussion by showing you how to arrive at the weighted average cost of capital. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. The cost of debt measures the current cost to the firm of borrowing funds to finance projects. In general terms, it is determined by the following variables. 1. The riskless rate. As the riskless rate increases, the cost of debt for firms will also increase. 2. The default risk and associated default spread of the company. As the default risk of a firm increases, the cost of borrowing money will also increase. 3. The tax advantage associated with debt. Since interest is tax deductible, the after-tax cost of debt is a function of the tax rate. The tax benefit that accrues from paying interest makes the after-tax cost of debt lower than the pre-tax cost. Furthermore, this benefit increases as the tax rate increases. The simplest scenario for estimating the cost of debt occurs when a firm has long-term bonds outstanding that are widely traded. The market price of the bond in conjunction with its coupon and maturity can serve to compute a yield that is used as the cost of debt. For instance, this approach works for a firm like AT&T that has dozens of outstanding bonds that are liquid and trade frequently. Many firms have bonds outstanding that do not trade regularly. Since these firms are usually rated, we can estimate their costs of debt by using their ratings and associated default spreads. Thus, Boeing with an AA rating can be expected to have a cost of debt approximately 1% higher than the Treasury bond rate, since this is the spread typically paid by AA rated firms. Some companies choose not to get rated. Many smaller firms and most private businesses fall into this category. While ratings agencies have sprung up in many emerging markets, there are still several markets where companies are not rated based on default risk. When there is no rating available to estimate the cost of debt, there are two alternatives. 1. Recent borrowing history. Many firms that are not rated still borrow money from banks and other financial institutions. By looking at the most recent borrowings made by a firm, we can get a sense of the types of default spreads being charged the firm and use these spreads to come up with a cost of debt. 2. Estimate a synthetic rating. An alternative is to play the role of a ratings agency and assign a rating to a firm based on its financing ratios. This rating is called a synthetic rating. To make this assessment, we begin with rated firms and examine the financial characteristics shared by firms within each ratings class. For instance, the Altman Z-score, which is used as a proxy for default risk, is a function of 5 financial ratios that are weighted to generate a Z-score. The ratios used and their relative weights are usually based on empirical evidence on past defaults. The second step is to relate the level of the score to a bond rating. How do we estimate a tax rate? To estimate the after-tax cost of debt, consider the fact that interest expenses are tax deductible to the firm. While the computation is simple and requires that the pre-tax cost be multiplied by 1 minus the tax rate, the question of what tax rate to use can be a difficult one to answer because there are so many choices. For instance, firms often report an effective tax rate estimated by dividing the taxes due by the taxable income. The effective rate, though, is usually very different from the marginal tax rate, which is the rate at which the last dollar of income is taxed. Since interest expenses save you taxes at the margin, that is, they are deducted from your last dollar of income, the right tax rate to use is the marginal tax rate. The other caveat to keep in mind is that interest creates a tax benefit only if a firm has enough income to cover the interest expenses. Firms that have operating losses will not get a tax benefit from interest expenses, at least in the year of the loss. The after-tax cost of debt will be equal to the pre-tax cost of debt in that year. If you expect the firm to make money in future years, you would need to adjust the after-tax cost of debt for taxes in those years. What about emerging markets? In general, there are 3 problems that we run into when assessing the cost of debt for emerging market firms. The first is that most of these firms are not rated, leaving us with no option but to estimate the synthetic rating and associated costs. The second is that the synthetic ratings may be skewed by differences in interest rates between the emerging market and the US. Interest coverage ratios will usually decline as interest rates increase, and it may be far more difficult for a company in an emerging market to achieve the interest coverage ratios of companies in developed markets. Finally, the existence of country default risk hangs over the cost of debt of firms in that market. The second problem can be fixed simply by either modifying the tables developed using US firms or restating the interest expenses and interest coverage ratios in dollar terms. The question of country risk is a thornier one. Conservative analysts often assume that companies in a country cannot borrow at a rate lower than the country itself can borrow at. With this reasoning, the cost of debt for an emerging market company will include the default spread for the country. The counter to this argument is that companies may be safer than the countries in which they operate, and that they bear only a portion or perhaps even none of the country default spread. What is debt? The answer to this question may seem obvious, since the balance sheet for a firm shows the outstanding liabilities of a firm. There are, however, limitations with using these liabilities as debt in the cost of capital computation. The first is that some of the liabilities on a firm's balance sheet, such as accounts payable and supplier credit, are not interest-bearing. Consequently, applying an after-tax cost of debt to these items can provide a misleading view of the true cost of capital for a firm. The second is that there are items off the balance sheet that create fixed commitments for the firm and provide the same tax deductions that interest payments on debt do. The most prominent of these off-balance sheet items are operating leases. Consider what an operating lease involves. A retail firm leases a store space for 12 years and enters into a lease agreement with the owner of the space, agreeing to pay a fixed amount each year for that period. We do not see much difference between this commitment and borrowing money from a bank and agreeing to pay off the bank loan over 12 years in equal annual installments. There are therefore 2 adjustments we will make when we estimate how much debt a firm has outstanding. 1. We will consider only interest-bearing debt rather than all liabilities. We would include both short-term and long-term borrowings in debt. 2. We will also capitalize operating leases and treat them as debt. Converting operating lease expenses into a debt equivalent is straightforward. The operating lease commitments in future years, which are revealed in the footnotes to the financial statements for US firms, should be discounted back at a rate that reflects their status as unsecured and risky debt. As an approximation, using the firm's current pre-tax cost of borrowing as the discount rate yields a good estimate of the value of operating leases. Outside the US, firms do not have to reveal their operating lease commitments in future periods. When this is the case, you can get a reasonably close estimate of the debt value of operating leases by estimating the present value of an annuity equal to the current year's payment for a period that reflects a typical lease period, that is 8 to 10 years. There is one final issue relating to capitalization. Earlier in this discussion, it was stated that the interest coverage ratio could be used to estimate a synthetic rating for a firm that is not rated. For firms with little in terms of conventional debt and substantial operating leases, the interest coverage ratio used to estimate a synthetic rating must be adapted to include operating lease expenses. This ratio can then be used to estimate a synthetic rating. What then? Should we use book value or market value debt ratios? There are 3 standard arguments against using market value, and none of them is convincing. First, there are some financial managers who argue that book value is more reliable than market value because it is not volatile. While it is true that book value does not change as much as market value, this is more a reflection of book value's weakness rather than its strength, since the true value of the firm changes over time as both firm-specific and market information is revealed. We would argue that market value, with its volatility, is a much better reflection of true value than book value. Second, the defenders of book value also suggest that using book value rather than market value is a more conservative approach to estimating debt ratios. This assumes that market value debt ratios are always lower than book value debt ratios, an assumption not based on fact. Furthermore, even if the market value debt ratios are lower than book value ratios, the cost of capital calculated using book value ratios will be lower than those calculated using market value ratios, making them less conservative estimates, not more. Third, it is claimed that lenders will not lend based on market value, but this claim again seems to be based more on perception than on fact. Any homeowner who has taken a second mortgage on a house that is appreciated in value knows that lenders do lend based on market value. It is true, however, that the greater the perceived volatility in the market value of an asset, the lower is the borrowing potential on that asset. Estimating the market values of equity and debt. The market value of equity is generally the number of shares outstanding times the current stock price. If there are other equity claims in the firm, such as warrants and management options, these should also be valued and added to the value of the equity of the firm. The market value of debt is usually more difficult to obtain directly, since very few firms have all their debt in the form of bonds outstanding, trading in the market. Many firms have non-traded debt, such as bank debt, which is specified in book value terms but not market value terms. A simple way to convert book value debt into market value debt is to treat the entire debt on the books as one coupon bond, with a coupon set equal to the interest expense expenses on all the debt, and the maturity set equal to the face value, weighted average maturity of the debt, and then to value this coupon bond at the current cost of debt for the company. The cost of hybrid securities. While debt and equity represent the fundamental financing choices available for firms, there are some types of financing that share characteristics with both debt and equity. These are called hybrid securities. Finally, estimating the cost of capital. Since a firm can raise its money from three sources, as we indicated at the beginning, that is equity, debt, and preferred stock, the cost of capital is defined as the weighted average of each of these costs. The cost of equity reflects the riskiness of the equity investment in the firm. The after-tax cost of debt is a function of the default risk of the firm, and the cost of preferred stock is a function of its intermediate standing in terms of risk between debt and equity. The weights on each of these components should reflect their market value proportions, since these proportions best measure how the existing firm is being financed. Thus, if E, D, and PS are the market values of equity, debt, and preferred stock respectively, the cost of capital can be written as follows.